let's take a look at the financial statements. So our income statement, super high level, your total revenues minus your expenses. You can also have, gains are treated similarly to revenues, losses with expenses. So your revenue minus your expenses, plus any gains minus any losses gives you your net income for the period. Statement of stockholders' equity is your beginning equity balance plus the value of your common stock. Anything that cash that the owners have contributed to the company that the company can use, plus your retained earnings, which is really just it's the earnings that the company retains. And you calculate that by taking your beginning balance plus your net income from the period, subtract out any dividends, gives you the earnings that you retain right after paying out some dividends, and that gives you your ending stockholders' equity. The balance sheet is your assets plus your liabilities. Assets equals your liabilities plus your equity. And I'll stop and say I find it helpful to think of stockholders' equity as just a part of the balance sheet, so that there are three financial statements, the income statement, balance sheet, and statement of cash flows. It's just that the statement of stockholders' equity can be very detailed, that it warrants its own, statement because there's so much that can go onto it. But generally in your studies, you'll talk about equity as really just a part of the balance sheet, just for simplification. Should also note that the balance sheet is prepared at a point in time. If you look up any company's balance sheet, it'll be listed as, Microsoft Corporation, balance sheet as of a certain date, their fiscal year end or fiscal, quarter end, as of a certain date. Think of, if you look at a bank statement, right? It is as of a certain date, cash balance as of a certain date. Whereas your income statement is for a period. I'll move this. All of the financial statements are for the period ended, right? Your income, your revenue, expenses, gains and losses that correspond to just, fiscal year 2021. Statement of cash flows shows the cash paid and received from your core operating activities, your investing activities, so investments that the company holds and then another company, and financing activities. You raising capital either through selling stock or issuing debt. It's important for companies to report the breakdown of where the cash they're receiving and paying is coming from. What is it being used for? Cash is important. So the income statement, I kind of said it's for a period in time, and if you're talking about a firm's performance, you're going to want to look at, it's kind of implied that you're talking about current performance. So so it would be for the most recent year. Balance sheet shows the position. You could think of that as your current GPA, as your cumulative semester grades. Your current semester grades are your income statement, which will be consolidated and added onto your GPA, right? Balance sheets show breakdown of funding and statement of stockholders' equity, made up retained earnings. We kind of already hit on statement of cash flows.